today's featured supplier is DSMA, and the topic is navigating the automotive buy-sell market. And Chuck Pappas, our VP of Operations, will come on in just a moment to introduce our presenter. We have poll questions, post-session survey, and a lot to share. So let's start things off now with Chuck. Chuck, it's all yours.
Well, welcome everyone, and thanks for joining another Profit Improvement webinar. We're glad you're joining us today. This afternoon, backed by popular demand, we're presenting Mr. Andy Church, who's the Vice President of DSMA. Andy has been one of our premier presenters and is in the top group that gains the most people who watch his webinars, so we're glad to have him here again today. So today, Andy will advise you on navigating the automotive buy-sell market. We have a slide up right now, so if you're interested in getting a copy of this deck, just scan the QR code and we'll make sure you get a copy off right away. After you review it again, I'm sure Andy will be able to answer any questions that you may have. We started this webinar series about 3 years ago, and in the course of these webinars, we have presented a wide range of category topics. Audit recovery, reduced shipping costs, marketing analysis, DMS systems, shop supplies, hidden opportunities for your service department. But our most popular buy-sell webinars is why we're presenting it again today. They're all intended to reduce expenses and improve your profitability. If you're new to these series, we encourage you to stay tuned and watch for other profit improvement topics that are coming up. With that, I'll turn it over to Andy. So Andy, take it away.
Thank you very much, sir. Appreciate it. Appreciate the invite again, Chuck. Really appreciate this is, I think, yeah, I've been doing this for a couple of years now, and it's kind of nice, actually. I get to do it about quarterly, give everybody an update on what's happening in the market and the changes that have happened throughout that. Throughout the conversation, though, if you've been on these before, you'll also notice that it's talk about generally the automotive industry, as well as some profit tips and things like that as you go along in your journey as a successful dealer. So let's get started. So we're going to talk about profitability and normalization and what that looks like from a merger with an acquisition standpoint and also from an asset standpoint. You know, for many dealers, their largest asset in their personal portfolio is the dealership or the dealer group for that matter. And so it's important to understand the value of that asset. So that's important. We're going to talk about real estate and how that looks in a transaction and recently the changes that have happened in the market over the last few years regarding real estate and what's happening there. We're going to talk about some buy-sell trends. Everybody wants to know always what's the multiples. So I am going to share with you the multiples as we see them currently in North America. We're going to talk about best practice for buying, best practices for selling, if you're in those two realms or worlds. And then also we're going to talk a little bit about what's happening in the future and kind of how we see 2024 and 2025 coming about. A little bit about DSMA. We are now over 60 plus industry experts in North America. We also do transactions in the UK and Europe now, continue to go over there. Over 475 transactions and over $7 billion plus generated in revenue. And I think the other one that I'm really proud of is over 1,900 valuations. So if you look at that, you can see here about 25% of our valuations become a successful transaction. Oftentimes people do valuations for other reasons, and I think it's important to mention that, and we'll talk more about valuations later on, but just because you do a valuation of your dealership doesn't mean that you're necessarily preparing to sell that dealership. There's the team 60 plus, and always good to show the faces, right? Real people, real deal is our motto because really it is people. I'm very proud to say that I believe now 6 of our staff are actually ex-dealer principals that we sold their dealerships for them, and they were looking for that next career path, too young to retire, if you will, and they joined our team as well. So very proud of that. And a lot of industry people are coming from manufacturer standpoint, accounting standpoint, and all that. So very proud of the team that I work with. Just so I get to know the audience a little bit today, if you don't mind, click on, are you a dealer principal? Are you into dealership management? Maybe looking to buy a store? Are you possibly a future dealer or just somebody who really loves the information and supports it? Oh, fantastic. Okay, good mix of the three, a few dealer principals, which is great, and a few dealer management as well. So very, very happy to see that. And then obviously there's a lot of good information here as well. So I appreciate all the support. So I'm going to continue on there. Let's talk about, I got it, profitability and normalization. So if you've seen this webinar before, I've talked about profitability and normalization every time. And the reason is because it is very important, right? When you look at whether you're looking at a buy sell or you're looking at just maximizing the value of your asset and maximizing your returns, understanding your true profitability is important. And, you know, I come from a 20 group background, and I was very, you know, happy to work with the dealers that I got to work with for so long. And a lot of the conversations that we had was around that profitability, how to enhance profitability. But also sometimes you end up having the conversation about what does that look like? And what we mean by the normalization side of that is when you look at your financial statement, that's not necessarily the true picture of your entire dealership profitability. There are add backs that come back. For example, you may have family members in the business or not in the business that are receiving some type of salary or income. You may have some off-statement money that comes back into the statement through reinsurance programs. There are a lot of different ways to actually maximize your dealership profitability and also do it from an accounting side. Obviously, you work with your accountant to make sure that you're being tax savvy as well and generating that. So whenever we look at an asset, certainly for a sale purchase or purchase, whatever that scenario might be, we look at what are these add backs that need to happen should a particular person other than yourself own the dealership. And that's the goal, is to understand what's the true value of the asset in its entirety. Some people over or under report expenses. The most common one we see here is in the real estate factor, on the rent factor. So you may want to, especially if you own the own the building and the land in another company, if you've not adjusted your rent recently, and understanding that there can be many advantages to actually looking at that to make sure that you're establishing a correct rent factor and charging the business the proper amount of rent, or you could be overcharging it. You know, those other scenarios can happen. So that's really what we talk about. We look at that. 3 key items to review when you're looking at that. And I've got an old saying, and I go back to it very often, which is there's only 3 ways to increase profitability in any business. And when we do evaluation, we start out with what we call the key performance indicators. And I'm going to talk about those in a few minutes. But really the only 3 ways to increase your profitability, and I always ask these questions when I'm doing a seminar or training or whatever, is increase your sales. In other words, your sales dollars, increase your volume, or decrease your expenses. That's it. There's no 4th way to increase your profitability at your dealership. So it's always a great understanding to either quarterly or on a yearly basis and on a weekly basis, sit down with your managers and understand, are we actually looking at those items? A lot of times in a particular sale, you don't have to be the top performer inside of a business if you're the seller, right? Sometimes we have many, many buyers who actually look for what's the upside potential or the upside opportunity in your business. So reevaluating your KPIs and understanding possibly where you're underperforming and overperforming can actually help you increase your business today and maximize your value for the long term. Expense categorization, this is another one I see quite often. You know, there's over 60 line typically expense categories, and we're talking about StrategicSource, who really loves categorization, and they're fantastic at that. So I give them that plug. There's over 60 lines, and I still see some people who have everything in miscellaneous expenses down the bottom. So if you've got large numbers in that miscellaneous expenses, you should be drilling down on what's actually in those items, because a lot of times you can find hidden profitability in expenses that you're not realizing or you're even spending. Other income is another area of opportunity. Quite often when we look at a business, if you look at the other income, miscellaneous income, if it's not tied to anything, what does that look like? Do you understand the purpose on why it's there? Many dealers have a strategy for why they report other income, which is below the line. And that's okay, as long as you know the strategy. That's the goal of all of this, is to understand. So you're making a strategic and business decision rather than just going by, you know, my controller doesn't like to break it out, my office manager doesn't know how to keep track of it, whatever it may be. The other thing to consider, and we consider during a normalization, is either extraordinary income or expenses. Oftentimes over the last few years, the most common example of that would be PPP loans, things like that. So are you including those in profitability? Well, that's an extraordinary item which typically would not be included in your business. Therefore, you should not be adding that to your long-term profitability when you do a normalization, right? If you sell back a particular franchise, many dealers have sold back one particular franchise or another, that we would actually look at. That's not real profitability. It's estimated profitability for the future that you receive payment for. So those are the type of things that we're talking about. Conversely, you may have some expenses that were one-off, estate planning expenses with your accountant and your lawyer as you go through some of that transition. Sometimes those things are quite expensive in the year, but they're really long-term things that you're doing. So we would add those expenses back to income so that you actually increase your profitability for those one-off type items. Hope that answers most of the questions when it comes to those types of items. What are we talking about? We're looking at statements, and it's funny for me because coming from the 20 group and profit form background, composite reports is one of the things that, we really look at. And what I mean when I say composite report is this is a report that typically it's provided by either the manufacturer or by, if you're in a 20 group or a profit form, it's provided by them. This gives you the ability to be able to look at your performance against your peer group. Sometimes that's geographical by region or nation or district. Sometimes that may actually be by volume size, so putting you in the same volume size. When you get these reports, they're great to be able to look at because it takes your financial statement, compares it against those peers, and gives you areas of opportunity to identify where you're under and overperforming in those particular ones. So composite reports is a very important one. Accountant reviewed statements, again, typically done at year end on this particular one, whether that's a tax statement or whatever it may be. Sometimes we do see these large spikes just in the month of December. Obviously, that's a decision that you need to make with you and your accountant, but I'm seeing more and more dealers really look at not having that giant change in December and really trying to smooth those out throughout the year, putting those expenses or income in the individual months where they belong. So that can certainly help. The last thing that we constantly consider is the market share. Are you sales effective? Are you over or underperforming in your particular market? So is there more opportunity, or can you sustain that particular market share if you're over sales effective, for example? So those are four key items to look at. Everybody looks at the statements. I'm suggesting that when you do these reviews with your management team, whether quarterly, weekly, yearly, whatever that may be, you should be really considering all four of these documents as key documents to assess your current performance and figure out ways you can improve. Key performance indicators, there's tons, right? And you can get lost in some of it by going paralysis through analysis. The idea is to take some data and turn it into intelligence. So really when I look at something, these are kind of my top 6, and a lot of what we look at. New and used volume obviously is important, but I put in there planning volume as well because I want to know how you're doing in your current volume. Also, if your particular manufacturer does it, some manufacturers don't issue a planning volume, whether that's weekly, monthly, or yearly, but some do. How are you performing against that planning volume? That can really help you to see is there additional opportunity in the marketplace that you're not currently tapping in on. Gross profit per unit, obviously that's a big one. And when we do a normalization, we ask questions, for example, do you have other accounts that money comes out? Are there packs, whether those be soft or hard packs that go into those numbers? F&I, and I'm quite fond, and you probably heard me say it before, if you've been on any of these seminars or anything, that the business office is some of the most valuable real estate in the dealership because you want to make sure that you're maximizing that training in that and also maximizing the opportunity to take care of your customers in the right way and help them make those decisions, but very profitable area. Service and parts. Over the last few years, I've been really looking at these from a trend perspective. After COVID, service departments took a hit in some areas just because of availability and things like that, shutdowns and whatnot. So now I'm looking to see is the trend upwards in those service and parts departments. They should be going up back towards and hopefully setting bigger records as people keep their cars longer sometimes as well. So I always look at service, and I think that's a key component to look at. That goes with absorption ratio because absorption ratio really isn't just about service. It's about expense management as well and how well the front end can actually handle and pick up the additional opportunity between the absorption. So absorption ratio really means how much can your after sales departments actually pay for the entire expenses of the dealership if you didn't sell a car, right? That's what we're looking to gauge there. And I got some statistics I'll show you in just a little bit around where those numbers currently sit today, in really in a post-COVID world, if you will. And then obviously the big one that we use from an industry perspective is return on sales. And that's going to vary by OEM, sometimes by luxury or domestic, whatever it may be, even sometimes by market, but it's a good level playing field to be able to look at and understand where those numbers are coming in at for your particular dealership. All right, so let's talk a little bit about real estate and whatnot, as far as in a transaction or in an estate planning scenario as you're working through the process. Quite often, the two biggest choices are you leasing or purchasing, right? Do you currently lease the property from someone else? Do you own the property? In a transaction, predominantly buyers want the opportunity to purchase that property. Some are willing from a cash flow standpoint to lease the property for a time period, but they ultimately typically want to purchase the property. Now, there's a third-party financing option that's come in to effect, especially over the last few years. People like Legacy Capital, there's other capital sources out there who will actually come in and purchase the real estate, usually on behalf of the buyer side, right? And then lease back that dealership to the buyer. So in other words, they'll come in and do an appraisal on the property. Sometimes they even offer more than appraised value on the property, depending upon where it is and some of their own analysis. But that allows you to have cash at closing and the ability to be able to use that money for financing the goodwill, other things like that. But it gives you an extra flexibility option on the buy side. If you're a seller who's thinking about, hey, how do I work through this process and generate some additional income, maybe to go out and buy another dealership myself, if you're in that buying mode as well, you can look at that, doing that with existing facilities as well. There's another opportunity there. Whichever one of those you look at, really you need to have an appraisal done. And I suggest to people that just like you should have a valuation done on your business, because you look at your stock portfolio every day to see is it going up or down, up or down. You really should have a valuation done on your dealership every 3 years, and you should have an appraisal done on your property certainly every 3 to 5 years, because property changes depending upon the market you're in, depending upon the area you're in, and it's good to have a handle on understanding what exactly that looks like. Now, the other component that comes with an appraisal sometimes in a transaction, if you're selling that property, is typically a bank is going to order what we call a phase one. And that's environmental report to see whether or not there's any issues, lifts, oil, whatever it may be. They'll come in and do some testing. And we call it a phase one because typically transactions stop there, right? If there's no issues found, there's nothing going on. Okay, fantastic. Everything's within the state level. This is very heavily governed by the government, obviously. Then it needs no additional work. But sometimes there could be a red flag that's raised that says, hey, we want to go into what we call a phase two. That's additional testing, basically, right? If there's a phase two done, they're going to make a determination at that point in time that either says, we're happy now, we believe that, okay, it's a localized thing, everything's good, and let's go ahead and move on. Or if there is some type of, let's say, contamination or whatever it is found, they may suggest that you have to do what we call remediation. Obviously, that's a cost and included in that. But typically, depending upon how much remediation is done, it's affordable and not unrealistic. So those are the things you need to understand in a real estate transaction: is how am I going to finance it? What am I looking for? Do I have a recent appraisal? And do I have a recent environmental to understand whether or not I'm going to have that impact? It kind of helps solve the unknowns, if you will. All right, so let's talk about some buy-sell trends. What's happening in the industry today? I will say that lease back, we are seeing that in more transactions, typically in larger metro markets than in the rural markets. So depending upon where you are in the country, that may or may not be an option as well. But let's talk about some buy-sell trends. First question, have you or your company ever considered participating in a merger or acquisition? I'll just give everybody a second here to answer this question. And we're talking about, yes, I'm currently pursuing. Yes, but I'm not currently looking. I'm thinking about it for the future. No, but I would consider it in the future. Or no, I'm not interested at all. All right, interesting. So about, numbers are still coming in. About 40% are actively looking for something. About 50% are interested but not currently working on something, and some people are considering for the future. So I think that's good information to know. So this is the right time to be gathering that knowledge and information as well. So thank you very much for your responses there. All right, let's keep going here. Okay, let's talk some multiples now. It's a little bit of an eye chart. You can see all the brands down the left-hand side there, and what's happening there. Hold on one second. Let's do that. Okay. It shouldn't be too surprising. Porsche, Lexus, BMW tend to be towards the top. Some of the luxury Mercedes-Benz tend to be at the top. The blue line there is the U.S. multiple. The gray just underneath it is the Canadian multiples. We do see a typical higher multiple in Canada. There are many reasons for that we don't need to elaborate too much on right now. But we do see that that's been a trend for at least the last 5 or 7 years. Slightly higher multiples in Canada versus the U.S. I think a couple of the ones here to mention that have had movement or whatnot, Volvo remains strong, which is good. And then you see as you go down the line there, you'll see Stellantis and some of the domestics rate lower than others. And then obviously at this point in time, Mitsubishi tends to be at the bottom of that particular issue. But I just was having breakfast with a dealer this morning who said they're bullish on Mitsubishi, right? So we may see some trend. They've had a lot of news lately about additional models coming to market and also open point opportunities. So there are some open point opportunities out there for that brand, and it's in an affordability range. So that's kind of where everything sits from a multiples perspective. And we do these quarterly. This intelligence report, and you can actually go to our website if you want to sign up for the intelligence report. It's no charge. It's about a 50-page report that goes through really the economic factors and some of the information that I'm sharing with you here in even deeper depth than I'm going into here. I think this is an interesting one. You've seen it in your business, right? Before COVID and then through COVID, you saw some record profitability for the automotive industry and record profitability for the dealers, which is fantastic. We saw the same thing when it comes to goodwill versus asking price. So we did see a lot of over asking price, and a lot of that happening in 2021, even in 2022. And what we've started to see through 2023 and 2024 is, some sellers have a very, very high expectations. They want all of that profitability counted into their performance. But often buyers aren't willing to do that, right? So when we look at a normalization, when we look at deciding what a goodwill should be on a particular store, we're looking at 5 years of data. Typically, we want to look back, sometimes even 6 right now, because most buyers in the world are looking at what did you do pre-COVID, what did you do 2023. Now, you can still weight those COVID years, but not at a 1-to-1 ratio. Typically, what we do is we're underrating those COVID years because profitability was a exceptional time that probably won't be repeated for a long time at this point in time. So 2023, 2024, and 2019 tend to be more indicative about where the industry is. So I would say that if you're looking to do things or you're looking to possibly sell, one of the advice I would give you is definitely seek a professional valuation from someone reputable, whether that's DSMA or someone else, but somebody who knows the automotive industry so that you're setting your expectations to be really realistic to what they need to be. There's still great activity out there and still great goodwill values. It's just a matter of it's not at the peak it was a couple of years ago. Why is that? Well, we know that COVID's over. Now, there's some lagging factors happening right now. For example, if you look at the economy, bank interest rates was contributing to one of the reasons, right? So a lot of buyers were having trouble in 2023 and earlier in this year getting some financing at rates that made sense because interest rates were quite high. Interest rates have started to come down on the real estate side. We've seen a basis cut from the Fed where they've actually kind of announced they're going to do another basis cut, or they're certainly signaling there's going to be another cut coming up here soon. So those types of things are now beginning to drive that cost of acquisition and that cost of capital down, which also allows for a better goodwill, better activity, more buyers back in the market than sitting on the sidelines. So I think you're going to see activity continue to progress. But this is kind of, you got to hit that trough and then go back up the other side, right? Environmental challenges. I think a year ago, we were still very much talking about EV and strategies and dealers' frustrations with that. I think for the most part, most brands have kind of come off of a lot of those demands and a lot of those expectations that were maybe unrealistic at the time, and started to be more realistic about what that looks like and how it does it. That's fantastic, right? That's fantastic news. And of course, inflation, which I'll show you in a minute here, one of the leading indicators, inflation is now down under 3% and predicted to continue to go down at this point in time as well. And then profitability dropping. That obviously has a case, right? So 2023, according to NADA, the average dealer was lower in profitability by 20 to 30%. So quite a difference. Now, it was come off a high benchmark, but still that's quite an impact as far as profitability going down 1 year on year. Days supply, this is also a factor in this conversation, right? So this is days supply, and you can see here the average across the industry is currently 74 days. Manufacturers typically say 60 days is what they want from an average perspective. So you can see to the right here, Jeep is one of the highest, currently at over 140 days. Dodge, Chrysler, Lincoln, kind of in that high range. Well, it's no surprise that some of those goodwill values for those particular franchises are also at a lower point than they were 12 months ago, 24 months ago, right? That inventory is having that same drive. Not surprisingly, though, go over the other side of the scale to Toyota and Lexus and Mazda, surprisingly too, right? Under the 60-day mark, and still very desirable brands, not always getting the highest multiple, but getting strong goodwill multiples and strong goodwill values in particular. And then you got a lot of people right in the middle, right? So from that perspective, day supply is something that you need to be cognizant of watching. It's gone up on average 43% year on year. I think now you're seeing a lot of manufacturers, including Stellantis, start to come in and actually take some dramatic actions, hopefully, to correct that and bring the inventory level down, which obviously allows dealers to be more profitable. All right, let me ask a question for you dealers out there and management staff as well. Do you expect to be more profitable in 2025 or less profitable in 2025? All right, I'm liking the votes so far. Okay, so 83% are bullish on more profitable in 2025. I think that's a great answer. And only 14% currently saying no, they don't expect to be more profitable in 2025. So I think that's good. As dealers, we are always optimistic, but that optimism quite often translates into action, and that action is what ends up really driving forward where we want to go. Well, thank you very much for your participation there. Let's talk a little bit about fixed absorption. I mentioned absorption earlier, and that's why I wanted to bring it up again in this profitability conversation. And you can see here broken out by luxury, domestic, and import. 2022 when profitability was the highest, no surprise, fixed absorption was also the highest. So fixed was doing a great job of that in carrying that load. Now we see it's come down a little bit, but it's still not, for a domestic franchise or an import franchise, really you're looking at 60 to 70%. And typically on a luxury, you want to see that around that 60 to 65%. Some people believe that domestics, and a lot of this comes down to, is that particular manufacturer currently have an image program or a recent image program that required a large investment in the facility? One of the biggest factors that makes the difference in whether or not you're a 80 or 90% absorption or a 50 or 60% absorption is how high is that facility and that rent factor. There's fixed expenses. So if you can keep those under control, obviously that's going to have a big impact on making sure that your absorption is something that's reasonable and a way that you can see yourself forward. Some U.S. macro indicators that look good, and I think I'm in the camp that you guys are talking about. 2025, I believe, is going to be more profitable for dealers, and here's some reasons why. If you look at GDP is forecast, we've hit the dip, and we've already started to come out of that dip. They're forecasting to go up to somewhere in the neighborhood by the end of next year to 3.5. So that's fantastic news. The funds, the interest rates are coming down. 3.5, and you can see there, as I mentioned before, they're indicating there's going to be additional rate cuts coming soon. That'll make capital easier. That'll also make automotive loans, so consumers who've been sitting on the sidelines because they didn't want to buy a car because the interest rates were just too high, they'll have the ability to come back into the market, right, and even tap into home equity and things like that. So as interest rates comes down, that should mean more profitability and better volume for dealers. Per capita disposable income, there's a lot of conversations about wage increases and things like that we're seeing some of those things happen and take effect, which is great, but it also means disposable income is going up as well. So that's nice news there. And then last, but certainly not least, inflation is now under 3% and looks like it's going to continue to be under 3% for the next few, certainly for the next few quarters, and hopefully going on from there. I saw a report this morning saying that Target, Walmart, and I can't remember the third one, honestly, but had cut their prices on over 8,000 items recently, just as soon as like this week. So going into that Christmas circle. Why? Because they saw that over the past 3 quarters of this year, holiday spending on those individuals, Father's Day, things like that, have been under where they were year on year. And they want to make sure that they don't have that same experience with Christmas. So therefore, they're lowering prices on household items to generate more disposable income to go out and purchase the Christmas presents and things like that. So I think that's a good indication of our economy, staying stable going forward. All right, let's talk about some advice for buyers and sellers. So let's start with the buyer side. If you're a buyer today, you're in the market today, or you're thinking about it, one of the questions I have for you first is how confident are you in your company's ability to navigate the M&A process, even if you've been through it before? Do you feel like you're more comfortable or less comfortable as you went through that? So give everybody just a minute here to answer that one. Okay, interesting. We got 20% very confident, 40% somewhat confident, 50% somewhat confident now, and 33% not very confident. So let's talk through some of these things, and thank you very much for your honesty. I don't see any names; it's all anonymous. So, but I appreciate your honesty, and let's take a look at some things that hopefully give you some additional confidence in looking through the process. All right, here's the common mistakes that we see, right? And whether you're working with an advisory firm like ourselves or you're trying to do it on your own, quite often I would start by saying use professional advisors, right? And DSMA is one of those professional advisors. There are many out there. Interview, find the one that fits you and fits what you're trying to accomplish, and then take it from there. But regardless of whether or not you work with an advisor, our firm or another firm, there are some common mistakes that we see people making that lead to deals not consummating. There's about 50% of all the deals that are out there in the world end up falling apart. And a lot of that is because of these reasons. First is you make the offer way too complicated, right? You don't even get on the guy's radar, on the seller's radar, because the offer is talking about, I need you to finance this and I need to do that, and whether or not I want to pay this for parts and this for used cars. Try to make the offer as simplistic as possible. There are some industry norms out there when making an offer that you can be guided through, but try to make the offer less complicated rather than more complicated. Second, not checking with your lenders. So if you're thinking about going out there and you're serious about it, one of the things that, and I mentioned it earlier, we do valuations for sometimes is so you can go to a bank and say, how much money can I borrow to acquire another dealership? Having that finance and that conversation first can save you a lot of time, energy, and wasted expenses if you don't have it until later on. You go, Andy, I find the deal first, then I go to the lenders. Well, that might not be the right deal for you. Having a conversation with the lender and understanding what a deal can look like for your potential and for your particular situation. Sometimes you can afford a lot more than you think you could. Sometimes you got to be a little more cautious and a little more understanding of what actually your level of investment can be. Checking with lenders first can definitely save you a lot of time and a lot of frustration on both your side and also the sellers. Because if you come in with a lender already secured or even a all cash offer, sellers are obviously, just like you would on a real estate transaction, look at that as a more favorable offer because there's less chance of that deal falling apart or not getting financed, right? Big concern for a seller out there is two big concerns. Can this buyer get approved by the OEM? Second, can they get financing in order to close the deal? And the reason I say the first one about the OEM is if you're trying to buy a particular OEM brand and you already have that brand in your portfolio, one of the things that OEM and all OEMs are going to look at is, are you currently sales effective in the brands that you're working with? You don't have to always be 100% or over hitting the ball out of the park, but you do want to look at your volume and say, am I close to representing the brand and the planning volume? That the brand isn't the impact. We all know some brands that you're underperforming in volume, they're underperforming in volume, so you're not going to have to. That's understandable. That's the exception, not the norm. But the norm is going to be if you have a planning volume and it's a stable, good brand and you're not hitting that planning volume, then you may want to take some time to see, how do I get to that planning volume number so that I make sure when I go in for OEM approval, I can already have that. Now, if you need help with looking at an OEM first or possibly applying to an OEM to see whether or not you can get approved beforehand, those are also services that advisory firms like ourselves can help you with as well. So putting that investment up front can save you a lot of time and energy on the long term. Confidentiality. This is a big one. We live in a world of NDAs. And if you're working with a broker, you're working with a firm like ourselves, you're working with an individual one-on-one, confidentiality is got to be key, right? Nothing kills a deal more than somebody's employees finding out, somebody hearing a word on the street that they were for sale when they're not really for sale or whatever it may be. So if you sign an NDA, please keep true to your word in the NDA and make sure that you're keeping those things. You would want to be treated that same way if it was your store that was selling, right? So if you're a buyer on the buy side, make sure you're being confidentiality. If you're a seller on the sell side, same thing. Keep the confidentiality so that you can keep the transaction moving forward. The last one I put here is not visiting the market, right? So things can look great on pictures. Google Maps, Google Earth, all those things are fantastic and give you a lot of good views. But nothing beats going and taking an actually drive around the town. Now, I don't suggest you go into the dealership. Nobody wants to see people walking around their dealership, especially if they're going to recognize somebody. But going to the town and doing drive around the town, trying to do some research on the market itself and making sure you understand what's happening there, that can save you as well. Because what you don't want to do is make an offer on a store that you've never even been to the town. You go to the town and decide this isn't for me. Now you've invested time and energy and expense. And also you're going to frustrate whoever's on the other end of that transaction if you change your mind. So try to do the due diligence that you would want to do before putting in that offer. So those are the common mistakes from a buy side. And obviously I'll open up for questions here in just a minute. On the seller side, I've mentioned it 3 or 4 times now, valuation is the most important thing. It just really is. It's, I have a friend who used to always say, do you think or do you know, right? And valuation allows you to know instead of, I think I know what my store is worth. A lot of times you end up leaving money on the table because you think it's actually undervalued. You undervalue yourself than the market would, and oftentimes. Be realistic about pricing. Right? Understand the brand and understand that we're not in COVID anymore, so we need to be realistic about what that looks like. Understand your balance sheet. What do I mean by that? Well, you don't have to clean it up, but you have to understand what's there, right? So in a particular sale, if you are a seller, if you've got a private collection of cars or a plane or a boat or whatever it is, and they're in your fixed assets, well, you got to understand that, when you go to sell your fixed assets, it's not going to be for the number that's on the balance sheet, obviously, because those aren't real fixed assets. If you've never depreciated your fixed assets, well, then you need to understand that you're probably not going to get the full value of that 10-year-old lift or whatever it may be. So you need to be realistic in understanding that part of the balance sheet. Same thing with receivables. Are those receivables real? Can they be collected? Because really, ultimately, you're going to be the one who's collecting them. Somebody's not buying your receivables. You're actually going to be collecting those receivables. So be realistic about what that looks like. Any loans that you have on the books. Just understand what's out there. We spend a lot of time talking people through and understanding what they're going to walk away with at the end of the day, not just the price, but what they're going to walk away with as far as cash at closing. And sometimes they can be adjusted and be surprised, caught off guard by the fact that their balance sheet has these items that are not real or not really part of the transaction. Trying to sell yourself in confidentiality. Boy, I say to people all the time, listen, if you're thinking about going down this realm, don't start dipping your toe in and calling the guy down the street or the guy next door and saying, hey, would you ever? Confidentiality gets violated that way. The market starts to find out. Now you've got some other issues, whether that be employee issues or valuation issues or whatever it is. So really just trying to do it, on your own and one people at a time can sometimes end up costing you more value and more deals in the long run. We have one dealer, several dealers I can talk about, but tried to do it themselves a couple of times. The deals fell apart, and then finally they threw their hands up and went, all right, now I need somebody to come in and really help me out. The problem is sometimes now it can be more difficult to walk through that process. You can still get through the process very successfully. So just consider those things. And then this last one, I love to say, we call ourselves sometimes the detailer of your dealership. We try to create a prospectus that allows buyers to answer 95% of their questions. So one of the things that you have that is the most visible part of a transaction is the facility and the property itself. So is it in good working shape? Would you walk through your store and be proud of the parts department? Some of those hidden corners and whatnot. Does it look like it's been well maintained and things like that? All those things, just like on a used car, you would recondition your used car. You should be looking at your facility and your dealership and saying, and really you want to be that way every day with your customer anyway, right? You want to show them your best foot forward. So it's a diligent thing that you can do and keep up with on a long-term basis that actually will go far to maximizing the value of your asset at the end as well. All right, let's talk about a couple challenges for 2024 and beyond. So I think I've talked enough about valuation here, but obviously just the reasons why you would have one done: buying and selling. You want to do some estate planning. You want to benchmark that asset to understand just like your portfolio. I talked about plan for growth. You can use it with banks, and then obviously managing risk as well to make sure that you're fully engaged. But let's talk about this. So what do you think are the biggest challenges that face us for the next 5 years? I do this poll every year, and it's interesting to see how the responses change. I'm sorry, not every year. Each time we do these seminars, so I'd love to see what everybody thinks in this particular realm. Interesting. Okay, a couple of these come through. Looks like most of the votes are coming in that economy, interest rates are going to have an effect. People, staff, succession planning, agency model got a vote, and electrification as well. So it seems like economy, people, staff. Obviously, it's an election year. That always has a big effect on what happens in our world and whatnot as well. And then people and staff has a big, big impact. What I would say is I think it's interesting as well. So they're all good answers. Nobody chose that Amazon selling cars. That seems to be something that's still kind of out there in the ether. Not really sure how that's going to land yet at this point in time. Electrification seems to have calmed down. I think a year or two ago, that in 2023, I think that was a big one on everybody's mind as well. People, staff, succession planning is always a big challenge that we face, just to make sure we're in front of that one as well. But I think there's been some good news too. One of the things I recently read, and I show it here. There we go. Just recently, I think it was last week, September 24th, so a few weeks ago, NADA put out a survey, a study that they had done. This isn't from Automotive News, but one of the reasons I got into this business is I'm passionate about the franchise model, passionate about entrepreneurs, and I believe that automotive is one of the last places that you can really create generational wealth to continue on. So it's been under attack for a long time, and NADA does a fantastic job of working with dealers to make sure the franchise model lives and continues to grow stronger. It's interesting to see, though, and we've been talking about it anecdotally forever, but now we're beginning to even see the science and the studies show that actually franchise model works best. It works best for the consumer. We already know that. Even here, it talks about hybrid distribution reduces personnel costs to a lesser extent because independent locations still have to complete centralization, right? So in other words, having a place locally that supports your local baseball team, your local employees, your local environment is really something valuable to the overall economy, as well as value to that local economy and also to the OEM, because we spend additional advertising dollars. You've got now every dealer spending advertising dollars promoting that OEM versus one OEM doing central and not having that personality profile in those different areas. So I think that's a great piece of news that came out just recently, and I hope to see more and more studies and more findings about that we can continue on. So I want to encourage you to go to NADA this year. It's coming up. It's going to be in New Orleans, but that's a great advocacy group and a great venue to be able to network with like-minded people who are in favor of the franchise model. All right, with that, they asked me to throw up a couple of testimonials here, just a couple of recent transactions. We've done a couple of power sports transactions. Power sports is becoming something that dealers are actually diversifying their portfolio sometime, from automotive to also adding in some power sports assets. So we've certainly seen a growth in that market. And then here's just a particular transaction that we did not too long ago with Brett Sutherland down in Georgia. So very proud of that transaction as well. And I think with that, Chuck, I am back over to you. And or I'm sorry, open it up to questions. I apologize.
Sure. Let's get ready for that. Everyone, you can ask questions here with the Q&A button at the bottom of your screen. And let's take the remaining time and cover as many as we can. So let me begin here with this one. What are the factors you consider in creating a valuation?
That's a great question, right? And you can almost do a whole nother webinar on how we look at evaluation and do evaluation. But I think some of the most important factors that you look at is three main factors. So what's the operation doing currently? In other words, what's it look like from a profitability standpoint? How well is it run? There's a buyer for everything. Some buyers like underperforming stores. Some buyers really like stores that are already performing very, very well. That's one key factor. OEM is going to be another factor. What's the brand? And what's the personality trait towards that brand? As we mentioned earlier, the value of a Toyota dealership may be very different than the value of, for example, Stellantis at this moment in time. The third would be location. Where is that dealership located, and what's the state of the facility? You've got different size markets. Those things are obviously going to have an impact on what the potential value of that particular store. So those are the three that I'd highlight: current operation, the brand, and the facility/market where it belongs.
I see several questions keep coming in. Do you expect more or less stores changing hands in 2025?
I think we're going to see, listen, the average age of a dealer is still over 70 years old. So I think we're going to see a robust market in 2025, especially as capital becomes more accessible again. I think that's going to be a very, very positive thing as that comes through. So I would say it's going to continue to be robust for the next few years. It's still about 92% of all dealerships are 1 to 5 rooftop groups. So I still think there's a lot of consolidation happening there. All right, let me go to the other questions. Hey, my friend Rob Ricketts. Hey, thanks for the information. What is the proper rent percentage on average that you're seeing today? That's a great question. Typically, what we see is somewhere between a 7 and an 8% cap rate. And what do I mean by that? You look at the property itself, and let's say, for example, it is a $5 million piece of property, land and building, the whole 9 yards. 8% of that is about $400,000 a year. Divide that by 12, and that ends up being what your rent factor is. So 8 on the high side. We've seen somewhere to 6 on the low side. So that's really the span that you would look at, 6 to 8% cap rate. Next question was, doesn't a franchise model study commissioned by the NADA seem a bit self-serving? Interesting point. Listen, I think at the end of the day, the agency that they did choose is a independent agency. Obviously, you could claim there could be some bias, but they're not the only study. That's the study, the most recent one that you've seen, but there's been other studies that have been done out there that kind of show, depending upon which angle you want to look at. There was one done a couple of years ago over distribution models that was comparing Tesla to OEM to typical manufacturer with franchisees, and it found that the distribution costs were virtually the same when it's structured in the cost. So there are different surveys out there, but I understand that question. Let's see, we had another one. What ratio of deals are you seeing as asset sales versus share sales? That's an interesting one, and it's a little bit of a divide here since we deal in both the U.S. and Canada. What we typically see in Canada is a majority share purchase sales, and what we mean by that is they're buying shares instead of buying the entire business. On the U.S. side, we typically see more asset sales. So it's starting to change. It depends on the tax laws and whatnot, but for the predominantly in general, the U.S. are typically asset sales, and Canada tends to be a slight majority to share sales versus asset sales. And then I got another question here. Fantastic question from my friend Elton Wetland. What effect do you find on state franchise laws have on values, i.e. Florida has no ROFO? I tell you what, that's a fantastic point. State by state, there's so many different laws in effect out there that happen. And Florida is one of those, we call it the Florida factor, right? One is you've got no ROFO, and what that means is right of first refusal, which basically means that if you're going to sell to this particular buyer, they can't come in and decide that they want to choose a different buyer on that particular deal. That has an impact. Obviously, Florida gets another impact. They've also got now where warranty parts are paid at the same gross profit percentage as customer pay parts are paid. So there's other state laws like that have a very good impact. Whether or not you can choose a dock fee or not, Florida has a very liberal dock fee criteria versus like a New York State who has a cap of how much you can do on that. Dealership facility is another one. Florida, for example, and there's several other states that have it as well, have we can't force you to do a new building kind of thing. So some of those facility type things strengthen the franchise laws. So the stronger the franchise laws, typically when you look at that multiple, one of the reasons there is a range is because in more business-friendly, states, more stronger franchise law states, you'll typically see towards the higher end of those multiples versus the lower end of those multiples. So the business environment has a big impact as well. I think I got to everybody, right, Dave?
Yeah, you covered it very well. Now, everyone, you can still ask questions of Andy with the remaining time with the Q&A button. He can answer you directly via that function. Otherwise, Chuck, can you activate your webcam and we can continue with the next part of the webinar?
Okay, I just love these webinars when they go this long if people have that many questions, Andy. Just goes to show you what a great value you bring to all of our clients and the people who are interested in our business. So we would encourage you to reach out to Andy to find out more about navigating that automotive buy-sell market and maybe how it pertains to you. You can have Andy's contact information on this slide, so you can feel free to get a hold of him. Oh, this webinar is will be up on our website in the next day or so. Just scan the QR code, supply your info, and we'll forward you a copy just soon again. Thanks again, Andy. Appreciate that webinar. For anyone thinking about their expenses right now, and I'm sure almost every car dealership is, how much money are you leaving on the table is the question that you have to ask, because most dealerships are overspending on supplies and services each month by 25%. There's about 150 expense categories, or at least category options where you can spend your money. Most dealers will spend in roughly 100 of these categories. Spend as a percent of sales equals about 5%. So if you do $100 million in sales, that 5% equates to $5 million. 25% of that looks like $1,250,000 on an annual basis, which you have the ability to save with StrategicSource. 95% of the dealerships in the United States are decentralized, meaning that they do not have a purchasing department, and the locations are feel free to buy from whoever suppliers that they choose to buy from. StrategicSource can be that purchasing partner for you. The business problem is that there are too many categories. Typically, there's not a plan to effectively attack those categories. Dealers are short-staffed, definitely short-staffed, and StrategicSource has a lot of experience in cost reduction analysis. Last year, we completed over 2,300 sourcing projects in the expense categories that are specifically used by dealerships. Your expense challenges are that dealers are typically overpaying for supplies by 25%. Think of that, 25%. You wouldn't buy stuff on Amazon at 25% more. Why would your dealership? There's a broad scope of categories that are and there's too many suppliers to manage, too many supplier invoices to process, and then it takes labor to do all that. And there are too few discounts or rebates that you get a chance to cash in on. So the question or the challenge becomes simply, how can you do that? This slide is probably one of the most important slides that we have. And we have QR codes that you can scan, put your information and anything, but this one, if there's anything to take away from this presentation, it's this slide. This slide shows what the annual savings opportunity might be for 4 different size revenue groups, ranging from 60 million to 300 million in annual sales revenue, and what the savings can look like on a monthly basis. Remember, these cost savings drop right to your bottom line, so it has an immediate effect on your profitability. And these savings are guaranteed. Well, you can find out how much you can save by just clicking on this QR code, and you can go through a little process that'll help you do that. You can figure that out. But the slide that I just showed you before gives you the general idea for those. This will be more specific to you. Our category expenses, we'll just touch on this briefly. There are 72 categories regardless of what kind of a business that you're in. If you're a dealership, a church, a manufacturing company, or a service provider, you're likely to spend in these 72 categories. If you're an automotive dealer, there's another 56 expense categories here. So you can see how that scope of work is quite large, up to 130 to 150 different categories, and it can be a bit overwhelming. If you own your own facility, or even if you are leasing it, you're probably spending in these next 15 categories that are available for you to purchase from. StrategicSource Solutions. StrategicSource has some solutions that can help you. Our profit improvement program, we manage the process of conducting a financial analysis of your spending. We do spend category planning. We source money-saving solutions for your spend categories. We implement solutions. We review and perform supplier compliance audits. The problems StrategicSource solves and help you correct are high expenses and broad supplier bases. Another tool is our strategic spend analysis. This is a more strategic, broad look at your expenses. We analyze them, we put them in the correct category buckets, and build a plan for you to execute. Client benefits are you get an organized, prioritized plan and a good staff planning tool. All with the idea that we can help direct you to a 25% savings. Contract tracker. Most dealers have a number of contracts. Too many contracts. I saw somebody process over 100 contracts just for one client, to give you an idea that there's a lot of contracts that are out there, especially for larger dealerships. Keeping current and managing all the terms of these contracts can be a pretty daunting task. SSI Contract Tracker gives you contract visibility, advance alerts on expiration dates, and a risk mitigation. You may need to renegotiate. You may need to get out of that auto renew. There might be a whole bunch of different things that you can change, and this gives you the time to have the ability to do that when you can review those contracts. Our spend management suite solves the problems of poor staff training, no contract management, high prices, and weak profits. SSI's spend management suite provides strategic focus, contract tracking, improved pricing, and profits. Expense Edge was created from our database of thousands of price comps. We've been doing this for a long time, many years, and we have a lot of information to draw from. This is similar to Home Depot. We provide the tools and solutions for you to do the work. We give you the data points so you can keep your costs down. Spend management learning. We do a lot of training in the areas of spend management. We've trained many folks to do, we do many webinars on purchasing 101, 102, and 103. Simply put, we can teach your staff to do what our team does. Hopefully this has been a helpful presentation today. Again, scan the QR code and we'll get information out to you right away. Thanks again to Andy Church from DSMA for his presentation. Always a great presentation. As a note, StrategicSource does not take any type of compensation from our suppliers, but we do know that we vetted them. We know that what their work product is, and we know how competitive they can be. We would encourage you to take a deeper look at our suppliers' offerings. Thanks again for attending today. David?
All right. Thank you, Chuck. And let's bring up the post-session survey. We're just touching past the top of the hour, so let's bring this up. We'd love to get your feedback on 2 simple questions. We do appreciate everyone's time. So there you have it. Thanks everyone for your time today. And we look forward to you joining us on future profit improvement webinar events with Strategic Source. Have a great rest of the week, everyone.